What is the state of the economy today? And how did we get here? My guest today is Joseph Politano. He writes the substack Apricitas about all things macroeconomy, including housing markets, job markets, energy, inflation, trade, and more. We talk about the history of the modern Fed and how it tries to keep both inflation and employment at the right levels. We talk about what happened that caused inflation to run wild in recent years. And we debate whether or not the Fed will be able to achieve its desired soft landing. As always, if you want to support the podcast, you can do so by going to patreon.com/Neoliberal Podcast. You can also become a member of the Center for New Liberalism at cnliberalism.org/become a member. We appreciate your support very much, and I hope you enjoy the episode. Welcome, everyone, to another episode of the Neoliberal Podcast, part of the Center for New Liberalism. I'm your host, Jeremiah Johnson, and my guest today is Joseph Politano. Joseph, welcome to the show.
Hi, I'm happy to be on. Thanks for having me.
So I have been reading your blog for quite a while, and it's one of the best sources I find on just kind of the nuts and bolts of what's going on in the economy. But I want to start not with what's going on in the economy today, but kind of with some history lessons, because I feel like in order to understand what's really going on with, like, what is the Federal Reserve trying to do, what's the inflation right now, it would be really helpful to talk about the history of how we think about, like, recessions and inflation. So can we talk about, like, I guess from a very basic thing, how does classical monetary theory work in terms of, like, what is the central bank, what is the Federal Reserve trying to do when it talks about moving interest rates up or down to control inflation, to help jobs? What is the balance they're trying to strike?
Yeah, it's a very interesting part of, like, modern macro. And it's very funny because if you think about the modern central bank as an institution, is arguably only 50, 60 years old. And the theories of, like, how that central bank is supposed to work has changed radically over that time period. But I think if you were to go to Jerome Powell or Lagarde or, like, Kuroda, any major central bank governor right now, and say, how do you control inflation? They're going to give some answer that boils down to a combination of a few things. They're going to say, we by and large raise and lower interest rates on interbank loans or on government securities or on reserve balances at our central bank.
So when somebody talks about, like, the Fed is raising rates, that's the interest rate that they're raising is on loans?
Yeah, it's interesting because technically they target the interbank loan rate, the federal funds rate. Functionally, what they do now is they raise the interest rate on reserve balances. So you can imagine a bank has reserves with the Fed, and these are essentially obligations of the Federal Reserve to the banks, and the Federal Reserve pays a certain interest rate on that, and they raise and lower the interest rate on that to control the interest rates that feed through to the rest of the economy. And so the Fed is raising or lowering IORB, the interest on reserve balances, to control short-term interest rates. And the idea of what they're trying to do is say, we're trying to achieve, in the Federal Reserve's case, it's a two-handed objective. On one hand, they want full employment. On the other hand, they want stable inflation. The full employment mandate doesn't have a very hard definition, but the stable inflation one has a pretty hard definition now, which is a long-run average of about 2% inflation in the personal consumption expenditures price index. Very wonky, but the basic gist of it is they think they control short-term interest rates. That controls, credit to the real economy in the short term. That controls measures of real economic activity and nominal activity in the short term. That keeps inflation expectations anchored. That keeps inflation low. And over time, that also ensures that you're at or near full employment.
And I'm not a macro guy, but the intuition here is that as you raise rates, then it's going to slow down inflation because there's going to be less real economic activity. Higher interest rates means that it's more costly to do business. It's more costly to take out a loan or to buy a house or to start a small business or whatever. And so there's just going to be less economic activity, which means growth will go down, but also there'll be less money splashing around. So inflation will also go down. Is that kind of the baseline theory here?
Yeah, that's the baseline theory. And that's a very good, short way to put it. And the only other thing I would put in perspective there is they also want to keep in mind that at some level of policy, all you're generating is inflation. All you're controlling is inflation in the long run. And so when they're keyed into looking at nominal growth rates, that's what they're thinking about. And when you're thinking about a country like Argentina, which has, don't quote me on what it is right now, but it's double-digit, near triple-digit inflation. That's not the cause primarily of real economic variables. That's mostly the cause of monetary economic variables. And so they want to make sure that in the short term, they're constraining or moving the real economy so that over the long run, they don't have this issue of consistent and rising inflation. I think the specter for most central banks is the 1970s stagflationary period. They never want to go back to that.
Mm-hmm. It's interesting because I want to talk about how this works in practice through historical examples. And I definitely wanted to talk about the 1970s, early 1980s as an example of the trade-offs that central banks face. So could you tell me about what sometimes people call the Volcker recession? What happened in the 1980s and how did it kind of set the stage for the modern Fed?
So I think the Volcker shock is what a lot of people look to as the defining moment for the Federal Reserve or for modern central banks, for better or for worse. Basically, throughout the 60s and 70s, you had high above target and rising inflation to the point that inflation was extremely high during periods in the 70s. And this was a semi-global phenomenon. So a lot of major central banks were dealing with really high inflation over the time. In England, it was much worse, for example. And the kind of fairy tale version of the 1970s is that people didn't want to ever raise rates. They didn't really understand the monetary drivers of inflation. They looked at very high unemployment rates as emblematic of a lot of slack still remaining in the economy. And they looked at things like the oil shock in the 70s, the OPEC oil embargo, as drivers of inflation that were non-monetary outside the Federal Reserve's control. And things had just kept getting so bad that when Volcker came in, he famously just kept raising rates with the intention of killing inflation no matter the cost. And that was successful in the sense that inflation came down, but it also induced a very serious recession in the US and in most countries across the world. And that sort of ushered in the period of central banks thinking of inflation as a nominal phenomenon, as a monetary phenomenon. That's the classic Friedman quote about inflation is always and everywhere a monetary phenomenon. And it also induced this period from the Volcker shock to, I would argue, about 2008, that's generally called the Great Moderation, where most high-income nations had their central banks get inflation down to very low levels or down to target levels, and keep them there for long periods of time. So inflation sort of stopped being a problem, quote unquote.
This was the Goldilocks zone of, especially during the 90s, you had high growth, fairly restrained inflation. Everything was as beautiful as it could be.
Yes.
But that doesn't last forever. And we have the 2008 shock. In that episode, the worry kind of switched from, oh no, we're not dealing with high inflation. We're dealing with, very low inflation, almost deflation and low economic growth. And what does kind of our toolkit say that we should be doing in that instance?
Yeah, I think the 2008 period is like the next big shift for monetary policy. And I think that era really starts historically in Japan. Japan, like post economic miracle, struggled with really low inflation, struggled with persistent deflation where prices are going downward. And as a result, had like very low growth, very low real output.
And if I break in here, like for somebody who's not an economist, they might say like really low inflation sounds great. Deflate if prices are getting lower, why do economists kind of think that's not the case?
Yes. Okay. This is a good point. Why is deflation bad is kind of a hard problem to wrap around. But the general thought process is first, for you to have deflation, as a prerequisite, you have to have very low to zero wage growth. And that was like the situation in Japan for a long period of time, low to zero nominal and real wage growth, which is obviously bad. People, want their real wages to be increasing. The second period is that you have these what are called like nominal rigidities in the economy, and actually employment is like the number one example. Most people during a recession, if your boss came up to you and said, it's a really hard time in the economy, we're going to cut your pay by 10%, they would be furious, and understandably so. So companies don't try to lower pay by X percent. They lay off workers. And laid off workers is fundamentally incompatible with like the full employment goal. So if you're saying if prices are rapidly declining, if you're not hitting the inflation target persistently, then you have this period where wages are really low and employment growth is really weak. And that's like on its face very bad.
Yeah, this is sometimes I hear that like prices are sticky or wages are sticky, but they're sticky in the downwards direction. Like people really do not like a 2 or 3% wage cut would be like really offensive to them. Whereas a 2 or 3% wage increase is like very normal. We expect that every year. So like wages can be flexible up, but they're very sticky downwards. They do not like to go down. And that is a problem if you're facing deflation, I guess.
Right. And I wouldn't want to put, so I think sticky wages is where a lot of like the modern macro discourse sits, where like sticky prices are less important, except possibly in housing, but the sticky wages are really important. But even just beyond that, what I would say to people is like, if you're in an economy that has deflation or very, very low inflation, it means like ipso facto, there's very little growth. It's very, very rare for you to have an economy that has such low inflation and is growing at an appropriate level. So the post-2008 period is essentially major central banks in the United States and Europe dealing with these massive unemployment problems, these persistently low inflation problems, these persistently low employment growth problems, and being stuck at 0% interest rates for so long, trying to deal with these problems. And institutionally, right, all modern central banks were designed in this way so that they could combat inflation. They were a hammer built for a very specific tool. And the employment mandates in most cases were just like tacked on. It's actually very funny if you look back at like Fed meeting minutes or statements. They very, very, very rarely mention the employment mandate before 2008. And so now you have this institutional shift where they're trying to come out and look like, hey, we're a responsible central bank. We don't just deal with the inflation. We can't just deal with inflation. We have to deal with this other part of our mandate. We have to get jobs and growth back in our economy.
Yeah, I mean, even with the European Central Bank doesn't even have an employment mandate, right?
Yeah, technically, I do not think they have an employment mandate. Don't quote me on that because I know that there were a lot of things changed.
I know that at least historically that there's been a period, I think that they don't. And I'm pretty sure during the recession they did not. They were famously just inflation was their only mandate.
Right. And that was a lot of central banks. It's actually very funny right now because I think we are entering an opposite phase where people want central banks to do a lot of things. So most central banks now will have an inflation mandate and an employment mandate. And then people tack on, like in New Zealand, there's now a home price mandate. and there'll be like environmental mandates, and you're like, okay.
Yeah, there's people who want the Fed to be responsible for like divesting from oil. That's a whole nother conversation, but like
Right, a whole nother conversation. But the point being is, historically speaking, they focused almost exclusively on inflation, and that was regardless of whether they had an official mandate to focus on other things as well. The Fed had an official mandate to focus on employment. They kind of just, I don't want to say fully ignored it, but they deprioritized that heavily.
All right, so we've been talking about the history here and kind of what central banks are trying to do. Some of the past episodes, when there's been high inflation, what did they do? When there's been a great recessionary shock, as in the Great Recession in 2008, what did they do? They obviously in that case were more like, let's cut rates, let's promote employment, let's try to get inflation higher. But I think it's useful to know all that history and kind of a little bit of theory here to talk about what happened in the COVID shock, in the COVID recession and bounce back, and what it means for what's going on with the economy right now. So if we just start with the facts, how would you describe what has happened over the last 2.5, 3 years of the economy? What happened during COVID, and then what's happened as we came out of the pandemic, and where are we now?
Yeah, it's almost 3 years, which is pretty scary.
I know sometimes I still say pandemic world, but we're definitely not in pandemic world anymore.
We're gonna have to come up with some way to do like an early pandemic, mid pandemic, late pandemic. Someone's gonna have to create the historical breakers, because I don't know what to do.
Can we call it pandemish?
Pandemic.
Like, is that
what? So I guess the late pandemic period, or whatever you want to call it right now. What I would say is, in the lead up, so pre-pandemic, most economies had reasonably recovered from the 2008 recession, finally. So it had taken basically a decade, but they were at a point where they were close to a normal economy. The Federal Reserve had tried raising rates in 2018. That ended up being overdone. They decided that was too much, and so they ended up lowering rates shortly after. The basic gist of it was that economies were relatively okay, but they still were not able to take even moderately high interest rates, even like very historically very low interest rates. They were not able to handle. And then obviously the pandemic hit, and the pandemic was a big recessionary shock. People are stuck at home. People lose their jobs. People didn't have money to spend, didn't want to spend money, and couldn't spend money on some of the things that they wanted to spend money on. So you have this big surge of deflation. Prices for a lot of things go down a ton. There was that one day for people who remember where like oil in the United States was trading negative because there wasn't enough storage to fit all the oil in the US.
I do remember that. I remember the price of like Brent crude for like one day was like negative 50 cents.
Yeah, it was wild.
Take it off our hands. Yeah. Which tells you something about how much consumer demand is in the economy if you're literally having to pay people to take oil.
And so you had this big deflationary shock. You had basically every global central bank saying, okay, we have to lower rates, take all of the extraordinary measures we did in 2008 to restore economic growth and to make sure that this doesn't become another 2008 recession. That was like the big fear, was that this shock looks worse than 2008, and 2008 took us a decade to get rid of.
Yeah, I mean, I want to stick on this point for a second, because one of the things I think both in history and foreign policy and monetary theory, like I think it's a big recurring thing, is that you're always fighting the last war to some extent. You see this in like foreign policy where one war goes badly and so you're reticent to get into the next war, but then it turns out you should have jumped into that one sooner and blah, blah, blah. With monetary policy, it seems like in 2008, we did a bunch of, stuff. We did some fiscal stuff. We softened monetary policy to try to like help get us out of the 2008 recession. But it seems like the lesson we learned was we didn't do enough because it took so long. And it seemed like we really learned that lesson really well. And like we responded really strongly this time.
Yes, I would agree with that. And especially historically, it's very funny to look at the responses to the 2008 recession with the knowledge of what happens in the decade after. Like it's bonkers that the European Central Bank was raising rates in 2011 when unemployment was like 10% in the euro area, and they were raising interest rates. You're like, what? Who's piloting the ship?
I blame the Germans. Again, if we're always fighting the last war, it's like I think the Germans have this almost like intrinsic, like deep psychological, sociological thing in their culture about high inflation that like they just can't stomach it. And so that's what you see the European Bank raising rates when their economy is still clearly depressed.
Yeah, I think that's a whole separate discussion about like the German central banking influence in Europe. But coming back to 2020, so you had this big deflationary shock. You had governments around the world spending a ton of fiscal resources sent to households and businesses and other arms of government to insulate them from the shock. That was another big lesson of 2008, was like you had to send people money, you had to send institutions cash. And then by about 2021, so I want to say 2 years ago at this point, you had the first like resurgence of inflation in a serious way. And this was mostly driven by weird things in the reopening of the US economy. So the chip shortage, not having enough automobiles meant that used car prices went up like 50% in a matter of 6 months, which is crazy. And that put a lot of inflation. Gas prices started rising pretty dramatically because a lot of oil drilling was shut down at the start of the pandemic. And so you have these shocks to like goods prices and to a lesser extent energy prices and to a lesser extent at that point food prices. And then over time, so over the next year, you had, so ending in early 2022, so a year ago today, you had inflation that was, I would say, about half driven by these sectors that usually aren't influenced by monetary policy, like food and energy and manufactured goods, and then half by resurgence in rents and services and the kind of like core purchases that monetary policy thinks it can control more easily.
Yeah, can I jump in real quick?
Yes.
Because I think this is a core question that a lot of people have. The inflation that we saw is basically because after we got out of kind of the lockdown period of the pandemic, after we got out of 2020, and especially once vaccines were available and people seemed like we're ready to restart our lives, there's kind of two stories about why inflation was so high in 2021 and moving into 2022, and why it hit 10%, double digits at some point, I think, or close enough. If I'm wrong there, it's close enough. But there's kind of two main stories. One of them is the supply story that you mentioned first, which is because of the pandemic, all sorts of supply stuff all across the world's economy was disrupted. Literally there just weren't as many cars being made. The car factories shut down for a while, so there's not very many cars that are able to be sold, so the prices jump and inflation goes up. Or computer chips, semiconductors is another one where it's just hard to get everything shipped over here. There was big supply chain snarls and literally shipping containers across the ocean. Like there weren't enough ships to ship everything because people started ordering everything from Amazon. And so that's theory number one, is literally we're just having all these supply chain issues and it's a supply problem. But theory number two is more of a demand problem. And it says something like, well, look, the government gave everybody actually a pretty huge amount of money. At least if you're talking about the American government, it was actually a very, very generous package. There was all sorts of direct checks and turbocharged super unemployment and, PPP loans to businesses and all sorts of stuff. And nobody could really spend that money. Literally, we're all just sitting at home. We're locked at home. There's no movie theaters. There's no international travel. Nobody's going out to restaurants. And so then the world opens back up and there's just this like flood of people ready to spend all their money. And you could see that like they had lots of money. And so that's where the inflation is coming from, is just everybody's ready to spend money now. They've all got money because the government gave them money. So inflation rises because there's so much money splashing around. Is one of those stories true, or both true, or like how would you rate the importance of those two things?
I think at this point it has to be both, right? Um, and especially what I would say is if you look at like the nominal variables, so you say like nominal gross domestic product, um, so the total of all the amount money spent in the economy, that has exceeded the pre-pandemic trend. It exceeded the pre-pandemic trend in like mid 2021, and it's been growing at like an 8% annual rate since then. That number, that 8% growth in nominal spending, fundamentally is consistent with like between a 4 and a 6% inflation rate.
And so what you're saying there with the 8% is just literally not inflation adjusted, just the raw number of dollars people are spending is significantly above the trend from the pre-pandemic period, that literally there's just more dollars splashing around, whether that's because America is making more stuff or because the government just gave people money or whatever the reason. Factually, there just are more dollars being splashed around.
Right, right. And I think there's, entire schools of thought around um, aiming for some of these nominal variables. At its core, if you're looking for like a too much money chasing too few goods story, the fundamental way you look at that is looking at the growth in nominal spending, right? And I think that growth rate has exceeded the pre-pandemic trend, was too high for the last couple of years, but at the same time was not consistent with the total amount of inflation that we saw, right? So you're saying inflation is near 10%. I think it peaked at 9.1%. That with an 8% growth rate means you have to be having like negative real growth at some period. You have to be having some level of supply shocks. If you were to tell a story of like mid 2021, it's fundamentally a supply story, right? So you think about the parts of inflation that the Fed, that monetary aggregates can control. That's stuff like how much does it cost to get a haircut? How much does it cost to rent an apartment? These like big ticket purchases that are mostly about how much money people make and where wages are. Those prices were normal. It was, cars, food, gasoline, that stuff was in shortage. By 2022, the breakdown was about the same. So you're saying there's like 50%, it's, the Russian invasion hit food and energy prices really hard. You still had these ongoing shortages of manufactured goods and like the supply chain issues. But also now you have an increasing amount of spending in the economy that's filtering through to really rapidly rising rents. It's filtering through to rapidly rising like core services prices, and that's driving a significant chunk of inflation, more inflation than would be consistent with the Fed's target, even though it's not 100% of the driver.
Let's dive in there because you've been mentioning off and on a couple categories, and one of the things that that I love most about your Substack is the willingness to kind of get into the granular level data that Joseph Politano is not going to accept just inflation is high. He wants to know literally what is inflation doing in this specific sector? What is it doing for canned goods? What is it doing for oil? What is it doing for rent? So it's one of the things I love about the blog. So can you talk a little bit about, we've had this high inflation. What has been the pattern on a granular level in terms of, is it specific sectors of the economy driving it? Was it different sectors at the beginning and it's different sectors now? What's the story there?
Sure. So I think I find it useful to break spending into like four categories here. So you have energy, which is pretty obvious. Gasoline, if you have a gas stove or you're paying electricity bills, all that fits under energy. Then you have food, again, pretty obvious. Restaurants, grocery stores, any bulk goods. Then you have core goods, so like manufactured objects that aren't food or energy. So excluding things that are like canned goods that are manufactured. Here you're talking about like furniture, computers, automobiles, things like that. And then last one is core services, and this is the bulk of people's spending. So it's things like your rent, your housing costs. It's how much you would spend to get a haircut. It's how much you would spend to go to the doctor. Things like that. Those first three categories are, by and large, especially during the pandemic period, not directly related to monetary policy, right? So no one thinks the price of oil is driven by interest rates. And the price of oil drove a lot of inflation over the last few years. It's down, now significantly. But in the summer, was very high. It was driving a lot of inflation. Similar story for food. Nobody thinks that the price of eggs is driven by interest rates.
I mean, if you ask Fox News, it's driven by Joe Biden's seething hatred of real America, but...
Of course, but that's not anything to do with Jerome Powell. But core goods are sometimes a little bit driven by monetary policies. So sometimes if interest rates change, that can feed through to car prices because, you can get a better auto loan. If the economy improves cyclically, like people are more likely to buy new cars, stuff like that. But generally...
And actually, you know what? I want to go back to the eggs thing for a second.
Yes.
This is a left turn. I'm sorry, I'm taking you on a different direction, but just because it's evocative, the eggs thing is happening like right now, and yes, some people blame. It's useful for conservatives to just be like Joe Biden's America. But another thing you hear, I've heard this with eggs, and I hear this with other things when it comes to inflation, and I don't want to forget to mention it, is the corporate greed argument. Some people will say, well, look, avian flu is going around and has killed like 20% of all chickens in the United States or something like that. And that's why egg prices are high. But other people will say, no, it's because the egg company is having record profits. And that's why, the egg prices are high. It's corporate greed. I probably have already given away what I think about this argument. But do you think there's any credence to that? Or is this basically just kind of a political non sequitur?
I will say it's mostly a non sequitur, especially when talking about like specific sectors, and it's frustrating because a lot of these sectors are like cyclical commodities. So oil is a good example here. There was a lot of complaints about Exxon making record profits. I think especially if you're like me and you care about the climate, that increased dependence on oil is really bad. But at the same time, you got to put in context with the last, 6 years before the pandemic, where all these oil companies were like losing money hand over fist. That's sometimes the nature of these commodities is they oversupply.
Well, they were just less greedy then. Seems
the Exxon executives didn't know what they were doing.
They were less greedy, and then they got greedy during, No, what's funny is obviously I kind of think this whole thing is horseshit. But I do. What I will say, and it drives me a little bit crazy, but the height of oil company greed discourse was when the president actually tweeted about this. Joe Biden had some tweet that was like, oil companies are record profits. They need to do what's right for America and stop, and lower prices. And it was some obviously political tweet. And the damnedest thing is that he did that right at the peak.
Yeah, he top ticked it to the day.
Was the peak, and it is only decreased in price from there. It's been like a steady decrease, and like oil prices, gas prices are much lower now. And so I look at that and I'm like, well, does he know something I don't?
I think it's, I think that's the story of inflation mostly fails from this idea that companies generally are reactive. Obviously they're trying to maximize profit. They're trying to maximize, net corporate value and all that jazz. They're lowering prices based on mostly calculated judgments about the state of the economy. And some of that, it's important to say, I think there are some sectors where there's been like margin adjustments that help drive inflation. But I think people have like kind of wildly overblown how important it is. And the specific sectors, sometimes you have to go through and think like, okay, yes, in the oil case, like OPEC is there. They're there to literally be a cartel that gets more money by restricting the supply of something. Um, but the primary driver of high oil prices in um, late 2021 was arguably not even OPEC. It was just the fact that, the Russian production had been hit really badly, you know? And so I don't want to like wholly dismiss it. I think there's even like stuff where you look at there's an Atlanta Fed survey that I always look at, which is asking companies about the drivers of inflation over the last year and what they think the drivers of inflation will be for their company. And a decent amount of them cite margin adjustment. But in context, compared to the amount that cite like material shortages, it's very small. To your point, it's not like everybody around the world universally decided, actually, now's a great time for me to be greedy. I was not greedy before, now I'm going to be.
Yeah, nobody's been greedy in Japan for several decades now.
Exactly.
But which actually, you could actually make that argument that Japanese companies are like too comfortable and willing to coast. But Gordon Gekko, they need a little bit more like greed is good in Japan. But I digress there.
I think, part of it, so to respond to that thing, like I said, it's partly about the context that you're in. And it's actually very funny over the last few years, you've seen Japanese companies like raising prices. And a lot of them, like, I don't want to say apologize, but they view it as like, sorry, like we really have to do this. I don't mean to do this, but they're very apprehensive about it because of how long the deflation has been.
Yeah. All right. So before I led you down this path, this stray path, I think we were getting to kind of the current state of inflation, because you were talking about the different,
yes,
sectors that, there's kind of the core sectors and the non-core sectors. Obviously, energy prices have cooled off a little bit. Energy and food were bigger contributions to this early in the pandemic. Now it might be a little bit more like services. Core services are what's causing inflation. But where do we stand right now? Because there are some people who say inflation is actually cooling off pretty fast right now, and the Fed might be able to achieve its legendary supposed goal of a soft landing. So I guess what I would ask is, number one, what's the state of things? And number two, what is a soft landing? And can we get one?
Got you. So I would say right now, inflation's definitely high. It's been, cooling off over the last few months. Keep in mind that, inflation's a change in prices over time. So the prices don't actually need to go down in a lot of cases, even though in some of them they are. They just need to grow at a slower rate. And I think there's some important signals, both in the fact that, like, we were talking about nominal growth, that's decelerated. Like nominal incomes have decelerated, almost back to pre-pandemic levels, not quite there yet, but definitely lower than they were even 6 months ago. That's going to feed through to lower inflation. Some parts of the consumer price index lag significantly. So like housing, because of how it's structured, it lags like what the current economic conditions are by about a year. And so we know that should come down, fairly quickly over the next year. So I think, let me be clear, the Federal Reserve has come out and said that they're going to get inflation back down to 2% come hell or high water. So that, I believe, was going to happen. The key question is on what timeline? And that second part, is it a soft or hard landing? The names are a bit confusing, but because they don't have like a specific definition, like it's not actually a real economic defined concept what a soft landing is. But I would say if you have inflation coming back down to 2%, back down to the Fed's target, without a significant rise in the unemployment rate, in my mind, that's a success. That's a soft landing. I would say right now, the officials at the Fed don't believe that that's the baseline case. They think unemployment has to go up to about 4 to 5%. So it has to increase by more than a percentage point in order to get inflation back down to normal. And that would be consistent with like a recession in the United States. So when people are saying that they're worried about a recession, it's not for no reason. The Fed says they think in their baseline case, like a small recession, quote unquote, is necessary to get inflation back down.
So I'm going to present the Pollyanna case here, because if a hard landing is we're going to have a recession in order to get 2% inflation, and the soft landing is that we're going to get 2% or close to it without any kind of recession, I actually think there's a pretty good chance. And look, I'm just a guy. I'm not working at the Fed, but I see these charts where like the headline inflation number most people look at is a 12-month rolling average, right? So like what happened over the last 12 months, the prices are, if inflation is like 6.5%, then it's, prices right now are 6.5% higher than they were a year ago. But I've seen this broken down by month. And you look at like what happened in January, February, March, the first 6 months of 2022, it was all like, 0.4 contribution, 0.5, 0.6 contribution, like really high numbers. And then once you hit July, August, September, and the whole second half of the year, you actually see like none of those months are very high. They're like 0.1, 0.2, kind of like fairly low inflation for the entire second half of last year. And I'm sitting here wondering, how are we actually already there? Like, I think the thing that I saw was that, if you just look at the last 6 months of 2022, on an annualized rate, the inflation there is already at 3%. And so I'm looking at that and thinking 3% is basically already there. Like we might already be soft landing as we speak. So am I too optimistic here?
I would say you're correct to be more optimistic based on recent data. So if you would if we were recording this podcast in August and you said, Joey, what's the chance of a soft landing? I would have said like 1 in 5, 1 in 4, 1 in 5. If you're coming to me today and saying, what's the chance of a soft landing? I'm saying 1 in 2. That's still really bad odds if you think about it, because if you go up to me in any normal year and say, what's the odds of a recession happening? And I say 1 in 2, you're going to go, uh-oh. But compared to, an 80% chance or whatever it looked like over the summer, it looks a lot better. And part of that is, we've gotten some serious policy improvements trying to get energy stuff back under control, which I think have very much helped. We've gotten some progress on, the car shortage, like being alleviated. We've gotten very lucky, like historically lucky with the weather, like unbelievably lucky with the weather. In helping, in the European natural gas crisis and in the energy crisis here at home.
Basically what you're saying with the weather is that, I know especially in Europe, they've had a very ahistorically warm winter.
Yes.
And it means that they don't have to burn a lot of natural gas, which is good for climate reasons. It's good for geopolitical reasons, that they're not as dependent on Russia. And then it also helps their economy, that maybe their energy prices won't be so high.
Right. The key worry was like all these European countries had to stockpile a ton of natural gas to get through the winter, fearing that things would be very cold and they need to burn through this really rapidly, and they wouldn't have access to Russian supplies that they normally use to get through the winter. But so far things have been relatively warm, knock on wood. But so those points are important. I would say what's most important is that we know housing inflation is going to come down over the next year. And we know that because if you look at new tenant signs, so like the CPI is tracking all rentals in the United States. They're sampling to try to get a representative sample of all rentals, not just people who sign new leases. But if you look at people who sign new leases, the prices are up in the ballpark of 4 to 6% over last year. Which is,
can you explain to me how this works? Because I want to make sure I have the intuition here right. Because what I've read on your blog is that the official CPI or whatever inflation measure actually, it includes housing, but it's like lagged. It's like housing from kind of last year data. And is it because of, like, I'll use myself. I signed a lease in August of 2022 and I'm renting my apartment. Let's say I pay $2,000 a month. So my current expenditure is $2,000 a month, But that's a data point from August of last year about what it costs to rent an apartment in August 2022. And technically, if I were to go out and get a new apartment today, they would have some different thing, right? It would have there's the difference between what people are actually paying right now and what they would be paying if they got something new. Is that kind of what we're talking about?
Yes, I think your intuition on this is exactly right. So, backtracking a bit, like housing prices about a third of the CPI, so they're really important. And the Bureau of Labor.
So what you're saying is inflation is NIMBY's fault.
It's I mean, it's not entirely, but it is partly, this issue of like, if you look at housing inflation in the U.S., it's been really high.
Just give me an excuse to blame this on NIMBY.
There's always
that I like to do it.
Yes, there's always a tax angle. There's always a housing angle. This is the housing angle. But the specific of it is that it's actually really hard to track housing prices, because they don't turn over that often, and you can't just look at the ones that turn over, because that could be a non-representative sample. So what you got to look is everybody's housing. So the BLS is picking a set of housing units. They come back to them every 6 months and they ask basically like, okay, what's the price for this housing unit right now? What that means is they could, you signed your lease in August, right? You signed for $2,000. Let's imagine you stay there for 7 months. So in August, they come up to you and they say, how much does your apartment cost? And you say $2,000. They say, okay, goodbye. And they come back in 6 months and they say how much it costs. You didn't sign a new lease. It still costs $2,000. And so they write the same thing down and then they say goodbye. And then month 7, you move out and it gets rented for $2,200, a 10% increase. They don't catch that until the next time they come back 6 months later, So, in the pandemic, for example, the impact on housing prices in the CPI didn't pass through fully for an entire year. And right now we're in sort of the opposite of the early pandemic, when like rents in New York were going down tremendously. Now they're coming back up tremendously because people are moving back to the city. But that was mostly a story about last year. So new leases over the last year up maybe 4-ish%. That's a normal-ish level. But if you look at like the housing component of CPI, that's up 8% over the last year, which is historically high, like only comparable to the 1970s levels of high, like crazy, crazy high. So we know that will come down, and that's going to be like a big headwind for inflation. But like I said, I think some of the charts that you see on Twitter are maybe a little too sanguine about like the whole situation. The reality is, even if you're at 3% inflation, which would be like a big success story, that's still 1% above what the Fed is aiming for.
Well, it's funny you say that. You're leading me so perfectly into the next thing I wanted to talk about, which is, let me start with the word credibility.
Mm-hmm.
Credibility is a big, important word when it comes to monetary policy and the Federal Reserve. And basically what we mean by credibility is that when you said, like, the Fed put out a statement that says, we are going to get to 2% come hell or high water, and, you take that as gospel. That they are serious about that, because they have built up a large degree of credibility over decades of they are going to do that. And this goes all the way back to Volcker, when it had double-digit inflation, and he said, I'm going to tame it. I don't care if I have to throw the country into a deep recession, a painful, like, double-dip recession. We are going to beat the damn inflation. And I think that episode is kind of the cornerstone of the Fed having credibility. When they say they're going to fight inflation, we know they're going to do it. We know they're serious about it. And so when they say they want to get back to 2%, and they've said, like, there's no chance, people talk about, should we go to 3%? Would it make more sense to have a 3% target? The Fed says no chance. We're sticking with 2%. We're staking our credibility on it. So that's the background here. But my question is, do we 100% trust that? Like, say inflation actually does come down to 3%. Do we expect the Fed to continue, like, painfully hiking rates at the risk of unemployment if inflation is at like 3%, or do we think that inflation gets down to about 3% and they might chill a little bit and they're say, okay, we'll see where it goes from here? And because, I guess the argument here would be that they tolerated under 2% inflation for like a long time after the Great Recession. So might they tolerate, not 5% inflation indefinitely, but might they tolerate 3% inflation, 3.5% for a little while?
Okay, so I think the credibility question is really important, and I think if you're Jerome Powell, right, that's kind of one of the things that keeps you up at night is this idea that people are going to stop trusting you, and so they want to make it very clear that this is important to them, and that, like I said, they're not going to stop. I think it's important to note the 3% is not in CPI. It's in the Personal Consumption Expenditures Price Index. So it's a different price index that tends to run lower than CPI. All of that to say in a very wonky way that like CPI might be like 2.5%, 3%. That would mean PCPI is 2%, and the Fed's like achieved its objectives. But I don't think that they want to stick it out on if inflation is persistently at 3% for a long period of time. I think they might stop raising rates. I think that's what they're signaling now, is they think that inflation might be coming down. They're willing to hold. They're going to raise interest rates by smaller amounts, and they're willing to like hold out, wait and see a little bit where things go. But that's it's different, very different than cutting or tolerating 3% inflation. It's just saying interest rates. We think that interest rates consistent with getting back down to 2% have stabilized at this level. The other thing I will say is I think the Fed has had some questions to their credibility over the last 20 years, especially after the 2008 recession, because they weren't able to fix the unemployment problem for a long period of time in 2008, and because now you have this inflation surge that they weren't able to control over the last year. I think people need to get serious about what they can control, what they can't control. They control interest rates, they control monetary policy, they control a lot of these nominal variables, but they're not all powerful in that respect.
Yeah, I mean, the Fed didn't promote the fiscal policy that dumped several $1 trillion of stimulus money that caused the great wash of dollars that probably caused some of this inflation. That wasn't the Fed, so.
Right, and a similar argument for 2008, where you're like, I think the Fed should have done a lot more in 2008, but if you take the financial crisis as a given, which I don't want to do historically, but I'm saying if you take it as a given, I am not convinced that they could have fixed things on a reasonable timeline with just the tools they had available.
Yeah, well, and also you have to remember that when 2008, they did a bunch of stuff that they had never done before.
Yes,
Bernanke
exactly.
was inventing shit every other week, trying to save banks and say there was a big question of is the Fed gone crazy doing too much stuff? And in the end, with the benefit of hindsight, economists tend to think that maybe they should have done even a little more. But it strikes me as unfair to say that in that moment they should have invented even more stuff. You know what I mean?
Right. Coming back to today, they want to maintain credibility. It's very important to them. And central banks like to talk about inflation expectations. This idea being that if companies, people, households expect a certain level of inflation, they prepare for it. And in preparing for it, they induce it. I think the mechanisms on that aren't quite as clean as people believe, or aren't quite as clean as people are taught in Macro 101. But there's a whole bunch of financial market measures of inflation expectations. And if you look at them right now, if you look at bond market measures of inflation expectations, they're not only back to a normal level, they're actually below a normal level after being very much above a normal level for at the start of 2022, so about a year ago. So the Fed's, hiking.
So you're saying the markets do find the Fed credible. They believe
Yes.
the Fed is actually going to get it down.
Yes, they believe the Fed is actually going to get it down. And in fact, I think there may be a little bit, their markets are a little bit concerned that they will get it, they will drop it below target. That's like part of the recession hard landing risk, is they worry that inflation dips below 2% for an extended period of time again. So with that said, like they're clearly having an impact. And I still don't doubt that they're going to be able to get inflation under control. Even though I think that this has been like a very hectic few years that has put into spotlight that central banks aren't all seeing, and they aren't all knowing, and they don't have like perfect control over everything.
True. I mean, that's very true. But at the same time, we've been talking about a soft landing. And as far as I'm aware, at least in American history, I don't know that there's ever actually been a soft landing. Whenever there's been inflation of above like 8% that had to be brought down, it basically always led to, you had to do it with a recession. So if Jay Powell actually pulls off a soft landing, I'm inclined to think he's a little more all-seeing, all-knowing than we thought.
It's not wholly unprecedented to have this kind of soft landing. If you look at like historical examples, you can dig up a few from like the Korean War era, which I think is not it's not fully like the post World War II and the post Korean War eras. Not the best comparable examples, obviously, because we aren't in like a wartime economy from the 1950s anymore. But if you think about this big shock to the entire economy that eventually recedes, I think COVID and wars fit that bill. And I think also there are examples from countless examples outside the United States of soft landings. Part of the reason people are like, there's no soft landings in the United States, it's partly because we haven't had really high inflation for a long period of time. So if you don't have high inflation, you can't have a soft landing because there's nothing to land.
Fair enough. I will make one prediction, and I will say this is kind of a low confidence prediction. And I don't have anything that's really driving this other than like vibes. But these are the vibes I get. I think inflation is going to come down to around the 3% level, and I think the Fed is going to chill. And I don't have a lot of proof of this, but I don't think they're going to change their messaging. Their messaging will still insist that they're moving towards 2%, but just something about the psychology of this, where you've brought inflation all the way down from 9 to 3%, and like you feel really good about that. It's not like I think they will be really eager to hit hard to get that last 1%. Like imagine in the wake of the Great Recession when, we're flirting with deflation and they get inflation back up to 1.8%. They don't actually care about getting it back all the way to 2%. They're just happy they got it to 1.8. They're not pressing to get it any further. I don't know. That's my final prediction, and it's probably not worth much, but we'll see what happens. So with my relatively worthless prediction there, we've got just a little bit of time left. So I'm going to ask the traditional final question that I always ask on this podcast, and that is, where can people go to learn more? I will start by saying that everyone should go subscribe to Joey's blog. This is Apricitas. Am I pronouncing it right? Apricitas. It's a Latin word, and I never took Latin, but apricitas.substack.com. If you want to learn more about the state of the economy, the state of the job market, the housing market, inflation, any of these things that you're constantly hearing about that actually impact our lives, go to apricitas.substack.com. You can also follow Joey on Twitter. He's just Joey Politano. Good follow. So I'm happy to promote you. But other than you, what else do you think people should be paying attention to if they're interested in what we're talking about today, about business cycles and inflation and economic statistics and things like that?
I would say there's like we're going through like this blogosphere renaissance, especially because the economy has been such a mess recently. So like there's a lot of good Substacks. I read Full Stack Economics a lot. I read Matt Klein's The Overshoot. My friend Kyla Scanlon has a great newsletter, especially if you're like more interested in tech stuff. And for podcasts, I always recommend Odd Lots and Macro Musings, which is macro musings out of GWU, and odd lots is Bloomberg product. But both of those are great for keeping up with like the economy. And yeah, I think it's definitely an interesting time. The other thing I will say is like, look outside the United States. I've been trying to like do this more. There's like so much interesting stuff that happens outside the U.S. and because we're Americans, we have the luxury of like focusing on ourselves and making everyone else care about us. But yeah, and it's going to be a really interesting time because even like you said, even when we get down to like 9% versus 3%, it's going to be funny because these numbers are historically like historic divergences that only look normal like in the lens of the pandemic, which was the largest economic disturbance arguably in human history. And so I think we're going to be in an interesting period for the economy for at least a few more years. I'm not worried about running out of things to talk about.
There will always be interesting things to talk about. I think we'll just have to see how it goes. Everyone, go subscribe to Apricitas. And Joey, thank you so much for coming on the podcast today.
Thank you so much again for having me on. It was a pleasure.